What is a market maker? A market maker is a financial firm or specialist whose job is to keep trading flowing smoothly. They do this by always being ready to buy and sell shares, so that other investors don't have to wait around for someone else to take the other side of their trade. In short, they make the market by ensuring there's a buyer when someone wants to sell and a seller when someone wants to buy. It's worth noting that market makers aren't the same as brokers. A broker connects you to the market and carries out your trades, while a market maker is actually willing to buy from you or sell to you directly. Why does it matter? Without market makers, buying and selling shares could be clunky and slow. Imagine trying to sell your shares, but no one is interested in buying them at that moment. You'd either have to wait or cut your price drastically. Market makers prevent that problem by stepping in themselves. This makes trading faster, smoother, and more predictable, which is especially important in big markets like the London Stock Exchange or the New York Stock Exchange. For everyday investors, this shows up in a simple way. When you tap buy or sell in your investing app, it usually goes through instantly at a fair price, because a market maker is there behind the scenes. On top of that, there are usually several market makers competing to offer the best buy and sell prices. This competition helps keep costs lower for investors. Here's a simple example. Let's say you want to sell 100 shares of a small tech company, TechCo, for £10 each. But right now, no other investor is offering to buy them at that price. Instead of leaving you stuck, a market maker steps in and buys your shares for £10. Later, they might sell those shares to another investor for £10 and 5 pence. That small difference, called the spread, is how the market maker earns a profit for providing liquidity. The spread also protects them from risk. If the share price suddenly drops to £9.90 before they've sold, they take the loss. The small margin on each trade compensates for that risk. What else should you know? Market makers are often large banks or specialist trading firms, and in modern markets, most of them use algorithms and high-frequency trading systems. This means computers are making thousands of trades in fractions of a second to keep everything running smoothly. They don't just help with shares, they also provide liquidity in other markets like bonds, currencies, or commodities. On many major exchanges, market makers have official obligations. For example, they must always be ready to quote both a buy price and a sell price during trading hours. This ensures that ordinary investors can trade whenever they need to. Well-known examples of market makers include Citadel Securities, Virtue Financial, and big banks such as Goldman Sachs. That said, market makers aren't without controversy. Some critics argue that they have an unfair advantage because they see trading orders coming in and can react faster than regular investors. Others worry that in times of extreme stress, market makers may pull back, making markets less liquid just when people need them most. To sum it all up, market makers act as the middlemen of financial markets, stepping in to buy and sell when ordinary investors can't immediately match up with each other. They keep markets liquid, stable, and efficient, while earning their profit from small price differences. For you as an investor, they're the invisible reason why you can usually buy or sell shares quickly at a fair price. But like any part of the financial system, they have their own incentives and risks. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.